Hi, I'm Dan Hanford, founder of the Multifamily Investor Nation and managing partner with PassiveInvesting.com. I want to thank you for taking the time to watch this session, which was originally recorded from the Multifamily Investor Nation Summit from January 2020. We had over 1,000 attendees and over 40 speakers, and I know you're going to enjoy this session. I want you to also take a moment to go check out the next summit that's coming up. We do them twice a year, once in January and once in June. You can go to MFINsummit.com to find out more information about the next summit that's coming up. I also want to encourage you to check out our premium edition of our Multifamily Investor Nation group. You can go to MFINpremium.com and start your free trial today. I also want to encourage you to go to multifamilyinvestornation.com and find out other ways that you can follow us and learn more about investing in multifamily real estate across the United States. Thank you again for watching, and now you can sit back and enjoy this session.
Old hat for you already.
Yes, it is. This is the third time for us doing this. This is my first time, I think, in that summit, actually you being in room one with me. I think you've been in the other room.
Brandon, yeah.
Yeah.
Exciting.
So this is going to be exciting. I'm looking forward to your session today. This is room one in his session. This is Yonah Weiss with Madison Specs. Want to first thank you and then recognize you as one of our platinum sponsors. And so really appreciate you sponsoring the event and looking forward to the value that we can provide for you. For those of you who are watching and listening, make sure you reach out to Yonah. He'll be a great resource for you. He'll be able to provide you a lot of good information. His topic today is going to be on what's the real reason real estate moguls are so wealthy. And so I know what he's going to be talking about because we utilize it here with our group, PassiveInvesting.com. But I did want to mention one thing before I tee up your bio here, Yonah.
Sure.
So if you want to go ahead and get your PowerPoint shared if you'd like and get that started, you can. But for those of you who had just joined us, make sure you go to MFINpremium.com and sign up and check out the premium membership for the Multifamily Investor Nation that we just launched today. Actually, it's our first day launching it. And so you can go and check that out. And there is a 60-day free trial for it because we're still building out some of the content within it. And so we want to give you plenty of time to be able to experience it and give you that opportunity to make that final decision. So go there now and sign up. And I'm going to go ahead and introduce you, Yonah. I think it's kind of funny to introduce you because a lot of people already know you, but I know that there's people on here that don't know who you are. So I'm going to introduce you here, and then I'll turn it over to you and have you take it away. So Yonah Weiss is with a company. He actually works with a company called Madison Specs, and Yonah is a powerhouse with property owners for tax savings. As the director at Madison Specs, a national cost segregation leader, he has assisted clients in saving tens of millions on taxes, including myself, through cost segregation. He has a background in teaching and a passion for real estate and helping others. So Yonah, I'm going to turn it over to you, let you get started with the presentation today, and I'll be in the background for any questions or issues that you have. And then after your session, we can tee it up for some questions and answers at the end as well.
Okay, wonderful. So thank you very much, Dan. It's a pleasure to be back here. Don't be confused by the title because, believe it or not, we're going to talk about cost segregation. I know a lot of people, I recognize a lot of names here on the call today. So hi, everyone. Quick shout out. Hope to see you all soon as well in person. And we're just going to jump right into it. So the title is different, but the topic is the same. So I'm sorry, I won't disappoint anyone, but yes, we're going to go a deep dive into cost segregation. And I guess Dan will field any questions if there are any. At the time, I'll try to open the Q&A box over here so I can take any notes of anything going on with a question box. And without further ado, let's just make sure I have a clock over here in front of me so I know how we're doing on time. So here's what we're going to do today. We're going to talk about cost segregation. And guess what? I'm not in my car today. I'm actually in the office, and we have plenty of time, plenty of space. We're going to get this done. Right. So we're going to talk about depreciation. What is cost segregation? What are going to be the benefits? We're going to talk about the opposite as well, because obviously not everything has benefits, and we're going to get into that as well to see what's going to be the benefits, what's going to be the downside. We'll go into bonus depreciation, which is a little confusing. A lot of people hear about this, but don't know that it's actually the same thing as cost segregation. It's just a more enhanced version of cost segregation. We'll talk about that, how it came about, what are the rules to it. when, you know, who should be doing it? When's the best time? And then we're going to talk about a real estate professional, which in my opinion is probably the best rule in the entire tax code. So we will, we'll go in there. Yeah. So thanks for all the hellos, the shout outs to everyone out there. Let's just jump right into it. So just disclaimer, okay? We're not offering you tax advice. You need a tax advisor for that. This is educational, informational. My legal team made me put this in, but it's true. I'm not telling you what to do. You obviously should discuss this because everyone's situation is going to be different, whether you're passive, whether you're active, what have you. So what is depreciation? Depreciation sounds really negative, right? It's actually a very positive thing. It's probably one of the most positive things that is out there for real estate investors in terms of tax savings, tax benefits, because depreciation is based on a concept that things go down in value. And I say it's based on a concept because we'll see shortly, it's really almost hypothetical. Things go down in value as time goes on, but real estate really goes up in value. It appreciates. It goes up in value as time goes on. So we're going to have to understand how this came in. The IRS gives a tax benefit, a deduction for the amount of money that was put into purchase of property. Okay, so if you spent $1 million to buy a property, even if it was leveraged, even if you borrowed it, even if it was seller financed, okay, you put $0 into it, but the purchase price was $1 million, you are now allowed to write off entire value over the course of 27 years for commercial properties, or 39 years for commercial properties, 27 and a half years for residential properties. Residential also includes multifamily. That's right. We're here on the Multifamily Investor Nation Summit. And so multifamily has a greater tax benefit than any other type of commercial property, because every other type of property depreciates on a 39-year schedule. I mean, you get a lesser deduction every single year. Multifamily, even though it's commercial, it's really also considered residential from a tax perspective, even if it's a 300 unit, totally commercial from a loan perspective, but it is residential from a tax perspective. You get more deductions each year because it's spread out over a lesser amount of time. Now, waiting 27 and a half years to take $1 million deduction is, you know, it's a long time to wait, especially even if you're not holding the property for 1 million years. You're actually, hi Vinny, thanks for the message. You're actually allowed to take only a little bit amount, right? $30,000 a year. So for, you know, however long you hold it. But there's actually a tax planning method, which is called cost segregation, a weird name, but it means breaking out the building into different categories, which depreciate on a faster rate. So we're segregating out the things from the structural components of the building to the things that are not structural, which actually depreciate. Again, depreciate means it goes down in value over time, but it really doesn't. Remember, it may go down in value over time, right? If you have a printer, okay, and after 5 years or so, you may need to buy a new printer. But the tax benefit is, the concept is that even if it's not going down in value, you're allowed to take the tax write-off of that as if it is going down in value. And the real kicker of this is, and the proof that it's just hypothetical, is the date or the timeline of depreciation starts when you buy a property. So if you buy a property that was built in 1964, right, it's, you know, fully depreciated, so to speak. It has no, right? But if you buy it today in 2020, your depreciation starts on day one. Your new 27 years starts today when you buy it, okay? And if you sell it 5 years from now, the schedule starts over for the buyer on his purchase price on day one from that time. So again, it doesn't have to do intrinsically with the value. As appraisers will look at a property for a bank, for a loan, they're actually going to look at what is the actual life of the roof, right? It has a 15-year life. It was put in 10 years ago. It only has 5 years left on it. The value is much less. That's totally different from this hypothetical tax deduction over here, which is just based on the concept, but starts over when you place that property in service, when you buy it on day one. Okay, so we're gonna, just a quick overview. What is you know, just to conceptualize, what is depreciation for all of you, right? Anyone has probably heard of this, but it means like this. Let's just break it down. You buy a property for $1 million. And the reason why I give this $1 million example is because we'll see shortly the benefits for a commercial property, a multifamily property at over $1 million is basically a no-brainer. I mean, there's so much tax benefit there. Under $1 million is going to be questionable, right? There are, you know, other methods of doing it that may not require an engineer. That's not what we're going to be talking about today. However, under $1 million, it's going to be questionable. Definitely worthwhile looking into and getting a free analysis, a free estimate. But let's just look at this. You have to allocate a certain amount to land. Dirt does not depreciate, meaning you can't write off, right? A tax write-off from your income tax, dirt. So the land, you have to allocate a certain amount. Sometimes it's 5%, sometimes it's 15%, sometimes in, you know, New York City, San Francisco, where property values are very, very high, land values very high, it could be up to 50, 60%. So 5060, it's crazy, but that's going to lessen your depreciable basis. Pretty much average is going to be 15%. We just did a property, which was an RV park, right? This week, we just finished it. It literally had like a 0.0001% land value to it. That was the appraiser. So basically all of the $1,000, 7094. That's $850 family. That if you're making of where do we leave off? Okay, and we're back. I don't know what happened there. Maybe the line was choppy. Okay. Lost
I went
sound.
choppy just a little bit there, and I think your screen's a little bit missing right now too. It might be helpful if it's a connection issue, Yonah, to just turn your video off for the rest of it and just use your slides. That might reduce the amount of bandwidth required.
Hello.
I was going to say, Yonah, it sounds like there might be a bandwidth issue on your end. So it might be good to just turn off your video to reduce the bandwidth and just share your screen. That might be helpful.
Okay, not a problem. We'll have to keep it that way, but you can hear me loud and clear now?
Yep, loud and clear. You're good.
Okay, I don't know what that issue was. Okay, so we're going to get back into it. I hope everyone's still there. Let's go back to the page. Actually, that's the wrong new share. How do we share that again? Okay, here we go. So where we left off was talking about depreciation, regular depreciation. So we're talking about $1 million purchase price. $850,000 is what your basis is. That's the amount that you're allowed to write off from a tax perspective. $21,000 of that is your tax deduction every single year for commercial property. If it's a multifamily or residential, it's $30,000 every single year. Now, if your net operating income is about $70,000, let's say, for $1 million property, it's pretty possible. That means you immediately get to deduct $30,000 from your tax, from your income tax. So you made 70, deduct 30, you're only going to be taxed on the remaining $40,000. Okay, makes sense? That's what regular depreciation is. However, you're still left with that $40,000. Cost segregation is the method, or one of the greatest methods of reducing your tax liability even further in those earlier years. Okay, so we're not creating deductions out of thin air. What we're doing is we are utilizing those depreciation deductions and front loading them so that we can reduce our income tax liability in the early years of ownership which makes tremendous amount of sense, especially if you're only holding for a short period of time, 5-10 years. You are allowed to get into it right, get those benefits right away and literally reduce your tax liability to zero in many, many cases. Okay, especially if we're going to do the bonus depreciation, which we're going to see shortly what that is. So cost segregation, one of the rules, and you can go and Google cost segregation audit techniques guide, which is the guide put out by the IRS. That risking that you, if the engineer actually doesn't come to the property and use those methods that are determined by, set up by the IRS, you are basically risking the fact that it's not going to be recognized in the event of an audit. Are we back? We're still off? I'm back. That's so weird. Okay. I'm really sorry about this. I thought I had strong bandwidth over here, but okay. Just keep me posted. I'll keep the chat open just in case that happens again. I guess the recording is going to be a little choppy. Sorry about that, my friends. Bear with me. So to the property, walk the property, must go and see, he's going to look at every single thing in the building and allocate the things into different lives. So you'll have things that are depreciate on a faster basis. Things like personal property, things like furniture, equipment. We're going to see a list very shortly of what those things are. You're going to break out, going to identify those things, assign a value to them based on, number one, industry standard values. Number two, regional standard values for those costs in those buildings. We're going to accelerate those deductions, meaning we're going to take those things that depreciate on a 5-year schedule and get that even faster, okay? Which is going to produce, non-cash deductions like, phantom deductions, so to speak, because again, these are deductions that you're going to be able to take over time. These are some incredible court cases that over the years discussed what cost segregation is and how it came to be. So again, this is not some new strategy. This has been around for decades and has developed over decades in finding out what is considered 5-year property, what depreciates on a 5-year schedule to be considered personal property to take those deductions. There are many, many court cases, and these are the court cases that establish the rules that, the IRS recognizes today. Some examples of those things would be like vinyl flooring or carpeting, right? Which seemingly are connected to the building and should be structural, but actually can be removed and therefore considered 5-year property. So here's 2 main categories of what the 5-year property is. So of what these things that can be depreciated. One first thing is property. That means things that depreciate on a 5-year schedule. All things you wouldn't even think of, right? Carpeting, furniture, equipment, appliances. And in a commercial building or in a multifamily building, there's a lot of this stuff, okay? And it can be literally up to 20%, sometimes 30% of the value of the property is going to be allocated to these 5-year personal property assets, okay? So you can just look over here on this list. This is actually taken from a real cost segregation study on a multifamily property. In commercial property is going to be different, but since we're on the multifamily investor nation, so this is what we're going to be doing. And we're going to look at a case study that actually goes in this property a little bit later on. The second category is 15-year property. It's called land improvements. Okay, so you're talking about asphalt, concrete paving, concrete sidewalk, concrete, all these things. Even though they're all concrete, right? The tennis court is also concrete. The pool is also concrete. But guess what? Each one of these things has a different value to it. So you may have asphalt paving, which is going to have a certain value per square foot, but you're going to have the curbing or the sidewalk is going to be a different value per square foot. And the engineer determines what those things are and gets those tax benefits earlier on. So you can literally, and I mentioned an RV park before, a mobile home park. This RV park we did yesterday, literally, my mind was blown. 87%, you heard me right, 87% of the property was allocated to 15-year land improvements, which means the pavement and the asphalt and all that stuff. So let's say they spent $1 million on this property, right? They're talking over $800,000 of a tax write-off in year number 1 with bonus depreciation, or a little bit every year of that for 15 years. So if your multifamily is awesome, but there are other assets that are even more benefit from a tax. Mobile home parks are so just tap. What are we doing here? We're not creating deductions out of thin. What we're doing is we are front-loading deductions. What this does is increases cash flow, and this is essentially what's called the time value of money. Time value means $1 today is worth more than $1 5 years from now. So it's not only just that $1 today is worth more than it is 5 years from now, but this is your money. Okay, and I'm going to say this, I will repeat it because this is so important. Taxes are not something that you are required to pay. Taxes are something that you're required to pay if you have a tax liability. Okay, now real estate is one of those things that you can reduce your tax liability to literally 0 and therefore not have to pay income tax. Okay, we're talking about income tax here. Don't be confused with property tax or anything like that. But I'll repeat it because it's so important. From a corporate world, we understand, we're used to the fact that taxes are immediately deducted from our paycheck, and it's just something we have to do. We have to give up, relinquish a certain percentage, sometimes a very high percentage of our earnings, if you make money. That's not true when it comes to real estate. You make money. When you file your taxes, you're not only after you file taxes, right? You're not deducting anything from your paycheck, right? You are only going to be filing on your tax return, and only after the fact are you required, or again, we're producing 0. Again, that's all your money. This is what cost segregation does. I see someone asked a question over here. Shalita, would an engineer still be required on a current capital improvement project? Can the invoices be used supporting documents to justify the use of the short tax under the macros? Excellent question, Shalita. According to the IRS, you actually still need, the supporting document is great. However, there are so many aspects that go into a proper cost segregation study, a quality cost segregation study, as you'll see. And so one of the things is using an engineer, someone who is qualified, besides for the numbering system, besides for the nomenclature that has to be used, besides for, citing court cases and citing all of the places where you're doing that. It could be used. It may not stand up. I know accountants will use that in the capital improvements section, project, and it can stand up. However, number one, if you're not an engineer, you're not, very well versed in the tax code of what those things are going to be falling under. Number one, you're going to be missing out a tremendous amount, sometimes up to 20, 30, 40% of what your potential benefits are going to be just because you're overlooking things that you don't know about. And number two, that it may not stand up in the event of an audit. So excellent question. Sorry to digress a little bit, but it is a very important question. And we'll actually get to it a little bit later, a little more detail. So again, on $1 million of reclassified assets, we're talking about $200,000 of after-tax cash savings. Again, this is just a sample. It's a number. After tax is really going to be subjective to what your tax rate is, how much you're paying in the first place, etc. But there's a significant amount. So who should be doing a cost segregation study? So this really applies to anyone who owes taxes, who owns real estate. Okay, this also applies to a business property. Any income producing investment property or business property can be eligible for, number one, depreciation, and number two, for cost segregation. You cannot do cost segregation on a personal residence. Now, what happens if you are house hacking? Who knows what house hacking is? Okay, if you've been on Bigger Pockets before, you know what house hacking is. It means that you buy a multifamily property and you live in one of the units. Oftentimes, this is done in a duplex or a triplex or a fourplex where you're living in one of the units, renting out the others. It can also apply to a large multifamily property. You cannot deduct depreciation from your personal residence. However, a duplex, you would basically have to split that in half. So half of it is going to be your residence, the other half is going to be investment property, and the square footage and the dollar amount are basically going to be split in half, and you're going to be able to take depreciation on that amount as well. So anyone can do this, whether you also have depreciation, it still applies. LLCs, it flows deal, right? You will get usually a depreciation deduction based on your percentage of ownership in that LLC, in that property, based on the shares that you own in that property. Okay, individuals as well. Anyone can do it. If you are a nonprofit or it's a government entity, educational institution, etc., cannot take depreciation, right? Is not tax liable. It's a nonprofit. This is a very important topic. What is a real estate professional? And I'll get to the next slide also, which will describe it a little more. Actually, I might do the next slide before I do the first slide. Yeah, I'm going to do that. So passive real estate professional, I'm going to go back to that slide again. Basically, it's like this. If you are, actually, let's go back to that slide. If you're, sorry about that. If you are a real estate professional, now, there's a great quote, and I quoted this before, right? A great book of literature talking about communism, right? Kind of in a funny way. And one of the quotes, one of my favorite quotes from that book is, right? All animals are created equal, but some are more equal than others, right? So obviously that's what the premise of communism was. It doesn't really work, right? Some people, everyone's equal, but really in the truth of the matter is other people have much more benefit. All taxpayers, I say like this, are created equal, but some taxpayers are more equal than others. And that's what this real estate professional is. Okay. If you have this status, and this is a defined box, you can check on your tax returns if you get this status for women. I mean, that you don't pay taxes. How does this? We'll see what the benefit is. And this is taken directly from the IRS. You are a real estate professional if you or your spouse have both of the following qualifications. Number one, more than half of your services, or half of the time you spend working in the tax year, have to be materially participating in the trade or business of real estate. Okay. So either you or your spouse, if you're spending more than 50% of your time involved materially in real estate, not just passively investing, but actually, asset managing, right? We'll see what the things are in the second column over here. And the second qualification is more than 750 hours during that tax year. Now, 750 hours is not a lot of time. It basically means you can't retire and not work and sit on a beach and still get this status. You actually have to put in 16 hours a week or 3 months out of the year. That's 750 hours, not a lot of time again, but it has to be, number one, more than 50% of your time or your spouse's time. Okay, this is so important. If you are a high income earner or your spouse is a high income earner, one of you should think about becoming a real estate professional, right? Doesn't mean you have to get your broker's license. It just means that you have to spend the time doing it. So Dawn asked the question, to document real estate professional, what would you suggest for tracking activity hours? Excellent question, because if you want to get this status, it is worthwhile to track your time. There are apps that nowadays you can use tracking, your time tracking apps. Those work well. It's great to create like an Excel file, how much time you're spending, analyzing your properties, how much time you're spending, doing other things for your properties, whether it's traveling as well. Yes, I can, if anyone, right, Stan asks, if anyone wants the PowerPoint afterwards, please send me an email directly afterwards. My contact information will be at the end and is in the brochure. So, or you can connect with me on LinkedIn and find me that way. But you can definitely get this PowerPoint. I'm happy to share with you. So this status is so important. And what are those activities? What are those trade or business? So the second category, this is from the IRS, you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, brokering. So if you're a broker, if you're operating, if you're managing properties, if you are acquiring, that means spending time actually acquiring properties, traveling to those properties, right? You have to own it. You actually have to own properties and acquire properties to get this status. But any of these activities can be accounted for in those hours. And basically, if you own properties and you're self-managing, it's almost impossible not to get this status, okay? It's so easy. So why is it so important? Okay, and this is going to change your life if you don't know what this is already. Okay, usually depreciation, everything we've discussed until now, these tax deductions can be used to offset income produced from your properties. Okay, because it's passive income. Passive income, right? Passive deductions is called depreciation, can be used to offset passive income from your properties. So one property to the other can also be used as well. However, if you're a real estate professional, and that's why I said it's like a superpower, and not all taxpayers are created equal, you can use depreciation and cost segregation, which creates huge depreciation deductions to offset all of your income. Okay, I'll say it again, all of your income and your spouse's income from any source. So if you're a syndicator, this is a great example. If you're a syndicator, you are taking fees as well, right? There's management fees, there's acquisition fees, all kinds of things like that. Those fees are going to be treated on a higher, right, tax rate. If you're a broker and you're making broker commissions, right, those income commissions are going to be taxed at a very high rate. If you also own properties and get depreciation deductions and are this real estate professional, you can now use those extra deductions to offset the income from your brokering, from your, fees, from any other source whatsoever, and your spouse's. So again, if your spouse is a high net earner, or you are, one of you should get this status so you can literally use it. Doctor, lawyer, whatever you are, you can now start to buy properties and use cost segregation to literally pay no income tax, or in many cases pay very little to no income tax. And so the difference between a passive investor versus an active investor is if you have a passive real estate professional, means that you are invested. However, you don't actually get to take all those benefits because you're not actively involved. You're not an active real estate professional. You're investing. You can use only those deductions to offset the income produced from the property. Now, that's great because this is income being produced. If you're passively investing in a property, that's income that's tax-free, basically, in those earlier years. So you are creating wealth, reinvesting that, and so that's great. However, if you have under $150,000 or under $100,000 of adjusted gross income, you can actually take an extra $25,000 of that and use that to offset your ordinary income as well. If you have up to, and it goes up to $150,000 where it phases out, right, 2% every dollar. Okay, so at $150,000, you can no longer get that, and you just can use the depreciation deductions to offset the income from the properties. Okay, is that clear? Any questions on that so far? And talk fast, but we'll keep. That was a big tax reform. It's still in. New comes in office. We hope not. We hope to keep a real estate investor in office. Okay, whether you like him or not, this is probably the best thing that has been done for real estate investors, which is called bonus depreciation. Now, some people think this is different than cost segregation, and it's not. What it is an enhanced form of cost segregation, and you can only do bonus depreciation if you already did a cost segregation study. It's an election, and what this election allows you to do is any property that you buy, whether it's new, whether it's newly constructed, whether it's an old property, right? Before, right, you could not take bonus depreciation except on a newly constructed building. It was only 50%. Now it's 100%. What does this mean? Okay, let me just break it down because I see this slide does not say it so clearly. Basically, it means like this. You can take any of those assets that are depreciating faster, like the 5-year, 7-year, 10-year, 15-year, all the stuff we discussed, right? If you remember, you go back to that slide over there, right? The 5-year personal property, the 15-year land improvements, landscaping, all that stuff. And it's usually going to be on multifamily properties, somewhere between 25 and 35%. That's usually what's going to be. Sometimes less, depending on what the property is, sometimes more, depending on what the property is. But generally, it's going to be between 25 and 35%. Means $1 million property, you're looking at least a $200,000 of these front-loaded deductions, which is spread out over time, over 5 years or 15 years. It's increasing your deductions over that time. However, now you can literally elect to take 100% of that in year number 1. Okay, so that means you buy $1 million property, you can literally take that 20%, $200,000 deduction in year number 1. Now, you cannot do it on a 1031 exchange, or if it's non-arm's length, so you just want to, deed the title to someone. That's not called a transaction. You also cannot do it on a flip, right? It has to be something that is actually producing property, income-producing property, and is held for more than a year. Okay, why would you do this? Okay, or why would you not do this? Even better question. So creating deductions, and if someone asked me this question a couple of days ago, if you don't have any income tax liability, and this is probably one of the things that we all need to understand out here. This is a great tool, a great strategy, but it is not for everyone. It's not for everyone. It is going to be beneficial to you if you have income tax, and especially if you're a real estate professional. If you're a real estate professional and you have income tax liability, this is probably the best thing since sliced bread. I don't even know how good sliced bread is, but apparently that's, people say that, so I'm saying it as well. Nevertheless, it is not going to be beneficial if you don't have any income tax liability. To create extra deductions, what's that going to do is it's going to create what's called a passive loss, okay? And it's carried forward. You can use that next year. It creates a negative balance on your tax return, so you're not going to pay income tax, and you have these extra losses that carry forward with you. It's not a bad thing, but it may not benefit you in this year, okay? It's going to benefit you next year. And those losses can be actually very beneficial. When you sell a property, they get released and can be used for other sources as well. However, right now it may not benefit you. So just to keep that in mind, okay, this is not something that everyone should do. And as I mentioned before, on properties that are under $1 million or under $500,000, I would say for sure, it's usually not going to be very beneficial, okay? Over $1 million, no brainer, definitely worthwhile to get that free analysis, that free estimate from me. You can reach out. And so when is the best time? I guess segueing, when should you be doing this? Now, a lot of people like to reach out and get this free estimate even before they acquire the property. They go under contract, right? Besides for reaching out to us for title, we're the biggest, commercial title agent in the country as well. A little plug for that. But we can also look and analyze the property from a cost segregation perspective and see what are you going to expect? What is your potential tax savings? You need to do it. You don't need to do it in the tax year that's being done, but it needs to be finished before tax filing is done. So perfect example, if you bought a property in December of 2019, right? And I just spoke to someone yesterday who literally bought a property on December 31st, the last day of the year. It wasn't scheduled, but that's what happened. He bought it December 31st. It is considered a property placed in service December 31st, 2019 property. That means you can get the tax benefits from a 2019 taxes, which you're going to be filing in March or in April or an extension in September, October. Okay. This is something very important to know. You can do it immediately. A lot of people do it immediately, but you can also do what's called a look back study to do it retroactively. Sorry. Go back to that slide. Retroactively means you don't have to do it in the first year. You can actually do it on year benefits. Need those deductions early, but now I can look back. You can actually go back. You don't have to amend any tax returns. You just help to file. This allows you to get those missed deductions, right? Everything that you missed. Okay, and this can be done whether on a newly acquired property, a look back study property acquired in past tax years, and on a renovation or addition. And this goes back to who asked the question before? Shalita asked the question before. So what is going to be done when you're doing capital improvements? And nowadays, a lot of people spend a lot of money doing what's called value add. right? You're buying a property for $1 million and you're going to put in another $500,000 of renovating the property. When should you do the cost segregation? So you can do it twice, basically. What happens is you do an acquisition study. You'll do a regular cost segregation study on the purchase price. And an engineer will come and analyze what's in the building, what's there. Then you can do what's called a write-off study and a renovation study, which you write off all of the assets that you dispose of, take those off the books, get those tax deductions, and then what you spend on the capital improvements, you can get those tax deductions in the new year, okay? Yeah, the look back study, Ed asks, how far can you go back? You can go back as far as you want. However, it's usually only going to be beneficial going back about 5 to 6 years. You can go back even further. However, if you think about those 5-year assets over 5 years, right, you're going to get a big lump sum of those extra deductions that you missed in the first year that you're doing the cost segregation study. Afterwards, it's going to be less. So you can go back further, but usually 5 to 6 years is going to be the best time to go back. But again, back to the renovation study, you can do the cost segregation on the acquisition, then take the capital improvements. The engineer will analyze the documents, will analyze the invoices, analyze the property again, and see what was put in. All those can be deducted, and you can get the bonus depreciation on that as well, on that amount spent, which is usually going to be a lot less because there's less structural. If you remember, I said about 25 to 35% can be allocated to a faster rate. The rest of it is considered structural, so depreciates on a 27.5-year schedule. On renovations, there may be a new roof, that's structural. There may be other things, but usually there is new cabinets, for example, putting in new flooring, carpeting, repaving the driveway, the parking lot. All that stuff is going to be accelerated to a faster rate, so you're going to get more cost segregation bang for your buck on the renovation side. And this is just talking about the catch-up depreciation. Again, you can get this all back in 1 year. You don't have to amend a tax return. Again, 3115, 3115. We actually do it as a service for our clients because it is a pretty complicated form. Most accountants are not used to doing. So we do this for you. So just to give you, I spoke about apartments, right? Multifamily. What is going to be the average allocation or reallocation in a cost seg study, in a cost segregation study? So apartments is usually, like I said, between 25 and 35%. I'd say the average over here, we're putting about 27, 28%. That's the average. Definitely seen a lot more, but other types of properties as well. You should know, you may be investing in multifamily, but there are other assets as well. And like I mentioned, mobile home parks that you see down here at the end is literally off the charts, okay? It can be up to 60, 70, 80%. Like I said, the RV park we did this week, 87% reallocation. It's phenomenal, it's mind-boggling. So if you're looking to get huge tax deductions and bonus depreciation, buy one of those properties because you can get all of that in the first year. The golf course is another great example. Golf courses as well are considered land improvements, okay? It's not just land, it's land improvements. So let's get into a quick case as a great example. Someone who buying a 32 unit, not so big, great way to start out his investment. He actually sold a number of single family properties that he had accumulated over a number of years, and he sold them and he wanted to do a 1031 exchange. Okay, 1031 exchange would have allowed you to use, right, to defer those capital gains tax on those. He had accumulated single family properties over a number of years, and they went up in value. $1.75 multifamily property. The sale, because the 1031 exchange failed. Now, if anyone saw recently, last week, I actually did a video on LinkedIn. You can go back and check that out. This is the story from that guy who was the frowny face. Anyone remember that? Okay, go back to my LinkedIn page. You can check out the video from last week where we did a 1031 exchange. Capital gains tax deferring. This was the guy. Now, without cost segregation study, I don't want to get into that too much. Without cost segregation, the regular depreciation would have been $54,086 every single year. That's great. From $1.75 million property that had an NOI of well over $100,000, okay, or like $120,000, even from the get-go, and he was raising rents, right? He was adding value. So the rents were going to be going up. The net operating income was going to be going up significantly, even in the first year, the second year for sure. So what did he do? 54,000 is great, but you're still left with a large tax liability of 50, 60, $70,000 you're going to pay taxes on. What he did was a cost segregation study, and we did as follows. Okay, 15% was allocated to land. Again, does not depreciate. And he was left with about $1.5 million of depreciable basis. Okay, $1 million or so, 72% of the property was applied to the 27.5 year. Okay, and this is what our engineers are going to do. There's a huge study, right, that they go into the property, analyze everything. A huge study, right, 80, 90, 100 pages long, which is detailing, right, not only all those assets, all the values, the calculations, all of that stuff. It is also going to be, showing all of the work, showing all of the sources from the tax code, from those court cases, which is supporting the evidence. But in the end of the day, what is it producing? It's producing a new depreciation schedule. It's producing these percentages and these extra deductions. So 72% is the structural components. Remember, I said that's going to be the majority. 122,000 was allocated to 15-year property. That's the landscaping, that's the pavement, that's the fencing, right? The signage, all that stuff, the curbs over here, all that depreciates on a 15-year schedule, 8%, pretty good. A 5-year property, that's all the furniture, fixtures, all this personal property, again, was close to $300,000, okay? 20% of the property, that's a pretty good number. What he did was took bonus depreciation, okay? $421,308 in the first year. Now remember, I said if you're doing regular cost segregation, you're going to take that $300,000 here, divide it by 5, that's an extra $60,000 a year of deductions. So he had the regular $54,000 and an extra $60,000 in year number 1 would have been great for him. He had a net operating income of a little over $100,000, would have knocked that out entirely. So why did he do the bonus depreciation? To get an extra $300,000 of deductions after all the income produced from the property was taken care of, was knocked off. He was paying 0 income tax on the $120K from the property. You know why? Because he had a failed 1031 exchange and was hit with a large capital gains tax. Why? What can you do about that? You can use the extra deductions for bonus depreciation to offset those capital gains tax, okay? And it has to come from another property, obviously like this one, but this is another strategy, another tool. It may not be for everyone. You're going to be using capital gains taxes, which are a lower rate than maybe ordinary income tax rate, which is going to be higher, and you're using those passive losses, which could be used to offset ordinary income later on. And without confusing everyone too much, this was the perfect strategy for this guy, that not only did he have no income tax from the properties, he also had no capital gains tax from the sale of those single families from the failed 1031 exchange. So this was a win-win for everyone. And as you see, this was a huge win, not paying, about $400,000 of taxes on a $1.75 million building. So again, you don't have to buy this huge, massive building to get large deductions. So someone asked before, does it need to be an engineer to do this? And the answer was yes. And this page here is directly from the Cost Segregation Audit Techniques Guide from the IRS. You can go to the IRS website and search for Cost Segregation Audit Techniques Guide. This is the 13 principles that go into a quality cost segregation study that will stand up in an audit if all of these are used. And this is what Medicine Specs does. This is what, the majority, I would assume, of, large cost segregation providers would do, but your accountant cannot do this. And this is why people ask me all the time, why didn't my accountant tell me about this? And the simple answer is, they can't do it, right? You need an engineer to do it. So either they're going to refer you to someone else, or they just are not familiar with it. And that's okay. You know why? Because, so someone else, Vivek asked over here, I'll get back to that statement in a second. I like to answer the questions live over here. Yeah, Vivek asked over here, the capital gains tax via bonus is also for real estate professionals. That is correct. However, it can also be used for real estate professional, but it can't be used to offset the income from the income tax.
if you're not a real estate professional. So, but that was his case over here. He was a real estate professional. Good question, Vivek. So going back to the 13 principles over here, it needs to be prepared by an individual with expertise and experience in the methodology. Okay, so just having an accountant who is not experienced in it, doesn't have the engineering status, cannot do it. Okay, there's a methodology, there's a system, there's explanation, not just enough to just have those numbers and produce a new depreciation schedule and use those invoices to create numbers. You also have to have an explanation of the legal analysis. Okay, you have to have the study, everything that goes into it, identification and listing of the properties that are sourced in the tax code, the 1245 property, the 1250 property, what is allocated to each, etc. And so it's pretty complicated. And I can show you an example if you want right now. So yeah, let me just, before I even get to that, just so you have an idea. Let me, how do I minimize this? You can still, okay, you can see my, I'm going to share my screen again. I'm just going to share my screen. So if you're still with me, you can see my screen. You can see my email, don't see that. Let's see a sample study. Oh, concentration study, just so you see what a sample study looks like. Multifamily property over here. Let's see, sample multifamily. This is a large multifamily property, and it's only 27 pages. This is a minimized one. Let's see over here, small residential apartment. Maybe this will help. Okay, yeah. Here's one. This is not so beautiful of an apartment structure, but you can see what goes in. This is a sample study over here, about 70 pages long. A small property. You see, there's a whole, there's a whole procedures that are described. The actual, you can see these numbers here. This is a smaller multifamily property, and it was a city property, and it was like a slumlord type thing over here. So the percentages are much smaller, right? Garden style are going to be much greater. Just so you have an idea, 11% instead of the 20% that we found, the 2% instead of the 8% of the 15-year property. But just so you have an idea what these things are, right? Again, you have this numbering system. You have a whole, thing that needs to be gone in here. You have cabinetry, carpeting, closet rods, right? Again, these are things that go in there. So it's very detailed, right? All the numbers, right? This is from the tax code, from the reports, industry standard values of things like that, unit prices, square footage of everything. So again, the calculations are going to be done like that. This is the sample depreciation schedule that's produced afterwards. So you can see over here that it's very detailed. This is what's going to go in here. I'm scrolling really quickly just to show you. So things, there's, the macro system, there's different systems that the AMT system will provide all these numbers, different ways of calculating your taxes for different people if they want to use that. And then there's the description, right? The whole description of the property that needs to go in that, as well as the evaluation of what these different classes are, okay? So that was the, let's see, a new share over here. Let's go back to our webinar. And we are going to, from the current slide, yeah. So we're back. And what do you need to look at when selecting a concentration study? So the number one thing is that they're engineers and accountants that are there. They're not just an engineering company. They're not just accountants. They actually are exclusively working on this because you're going to get the best bang for your buck in that case, because they're the experts. You want to actually, see that they focus, they're not outsourcing any of their work, because when you're outsourcing things, you're not taking full responsibility sometimes, and it can get a little bit messy. Make sure that you have a true assessment, which is, the review of the study. A lot of people I've seen that they'll get an estimate and they'll say, oh, there's a low number, there's a high number, right? We like to do a conservative estimate, which will show you what the potential tax savings would be even before you do the study, and it's going to be very conservative. Okay, which means your actual numbers are going to be much greater. And make sure that they will protect you in the event of an audit. And most companies, if they're reputable, will do this. Just make sure, because God forbid, if you were ever to get audited, you would not want this to get blown up in your face, because not only are there going to be penalties and, interest on all of the taxes that you took that you were not meant to take if it was not done properly, and they do challenge this, but you also get penalized. There's actually special penalties for doing this, not only for you, but for the engineers as well. So I don't know why they would risk it, but definitely worthwhile to look about it. So let's just, a little bit about Madison Specs, nationwide company, over 50, engineers and accountants, tax experts on staff, all Big Four accounting experience, over 15,000, I think at this point, over 16,000 studies. We did over 2,500 in 2019. So our volume is, the largest in the nation, work in all 50 states, and 100% audit protection. So we are there for you. We have, like I mentioned, a number of other services. Madison Commercial Real Estate, one of the largest title insurance agents in the country, 1031 exchanges, etc. Questions. So now is the time for questions. I allocate a lot of time. I know I talk fast, and we do have a question here. How are these services priced? Actually, question, Tom. So pricing is so work involved, and there's a sliding based on the square footage, based on tax savings. It's not contingent. I know there are some firms that will literally take a percentage, which to me is like thievery. Not just thievery, but it's actually looked down upon, frowned upon from the IRS, because think about it. You're telling the IRS that you're not considered a third party anymore. You're getting benefit based on the amount of deductions that are taken. So you're like in cahoots. So questions. This is my contact information. Someone asked. It's also in so you can take a screenshot of this, copy it down, my phone number, email if you have any further questions. But now's the time for questions. So my friends, if you've been on the whole time and you've been listening, I'm sure you have a question or two. So shoot. Anyone? Anybody? Bueller? Anyone? Can you guys hear me still? Anyone hear me? Okay, we're still here. Dan, I think we finished early, so we can play a song or something. I don't know. What do you want to do? No one has questions. It was that clear or that confusing? Okay. Theodore, yeah, so someone asked, oh, great. So Bill, thanks. You always ask good questions, Bill. I appreciate you coming on. Yeah, so 1 second. Let's just answer one at a time. Good. Keep going. Yes, we do this in all 50 states. How long, Theodore asks, how long is it costing you? So you guys are asking in the chat box, in the question, doesn't matter. I'm looking at both, so you can ask in either box. So Theodore asks, how long does the conservation study take to perform? So the study itself does not take a long time. It should be, a matter of days or weeks, and can be done very quickly, just based on volume and our, what we're doing. Like I said, we did 2,500 of these in 2019. So our volume is pretty high. So we like to, put it in a 6 to 8 week, time frame to complete this, which will include, the time the engineer goes out there, the time for preparing the study. We make sure that it's reviewed at least 4 times. So our engineers repairing it, our accountants are reviewing everything to make sure that everything is in order. So Bill asked, did we answer? We didn't answer Bill's question. When is it appropriate to do 179 deductions versus cost seg? So 179 deductions is a different deduction than cost segregation. It applies for commercial properties, not multifamily properties. And it applies for certain, mostly equipment and things like that. So it's going to be something on more commercial properties where you're going to get, you're going to have equipment. And the 179 deduction is going to be a straight up write-off, not going to be depreciated. Okay, so it's not going to be on the basis of the property. It's going to be just straight up written off as a write-off of the property. So yeah, there are a couple things that came about in that as well. But yeah, I hope that answered the question. Do we do this in all states? Yes, we did. Dismissing that. When is the best time? When is it best? Joseph asked, when is it best to engage a cost segregation study to perform the study before year end, after, between certain dates? Like I said, the best time to get your ducks in a row as soon as you can. The worst thing to do is to wake up, like right now in January, February, when you're filing taxes in March, and it takes a few weeks, takes a number of weeks to get it done. So it should be done as soon as you can. Don't wait till the last minute to get it done. I hope that answered your question, Joseph. Holly asks a question. Omar put his email address there. Omar, email me. I'm not going to copy this, and as soon as this chat is over, it's going to be deleted. So if you just copy down mine, please email me. That would be most helpful. Holly Williams. Hello, my friend. I was late, and you may have answered this already. Since we are early, though, yeah, we have plenty of time. Don't worry. If you are an LP and a syndication is liquidated, can you offset those gains with depreciation from another LP investment? Excellent question. Yes, Dan put so you can actually copy and paste. Thank you, Dan, for putting my email address in there. You can actually copy and paste that if you guys want, instead of taking a screenshot or writing it down. Convenience for everyone. Yes. Holly, can you use those if the syndication is liquidated? So when I was asking, when a syndication is liquidated, so either it's liquidated by selling a property, or I guess maybe they're going to buy out your shares, or maybe you sell your shares, etc. When you sell a property, I actually didn't touch upon this, but it's important to note. When you sell a property, you are hit with depreciation recapture tax. Now, recapture tax is something that happens whenever you sell a property. Depreciation recapture tax means you have to pay a tax on the amount of depreciation that was taken. So that when you sell a property and you have extra losses or you have losses that were created from bonus depreciation or from cost segregation over on, those losses get released. Okay, so first there's like a hierarchy. First, those losses, those extra deductions are used to offset your income, if you have any, if you're a real estate professional. If there's any left over, they can now go to offset the capital gains, like I mentioned before, as well as the depreciation recapture tax. So you can actually offset that in another way. Another way to get around that is by doing a 1031 exchange, which you're probably not doing in a syndication, but that also defers capital gains and depreciation recapture tax. It does not mean that you pay back depreciation. It means you pay a tax on the amount taken. However, something that is less known or less commonly known by people is that 5-year property or personal property, once you've allocated that from a cost segregation study on the sale of a property, you can take those allocations and say, guess what? After 5 years, that 5-year property has no more tax value to it, which means, and it should make pretty clear sense. I'm saying, all my appliances, let's take an example, right? My cabinets, okay, are worth $100,000 in this property. Now, after 5 years, I've depreciated it. So it no longer has any tax value to it. I'm not going to pay depreciation recapture tax on that if I allocate that amount on the sale. So you don't have to allocate it in the contract. It's a tax form. You're going to be allocating that partial asset disposition. Something a little more complicated, but please reach out to me to discuss that further. Can you have, Sydney asks, can you have a 9-to-5, this is in the chat box, and qualify as a real estate professional? Sydney, it is going to be very difficult. Okay, I'm not going to say it's impossible. Some accountants will say it's impossible, but you have to actually have more than 50% of your time spent managing and actively materially participating in real estate. So I'll give you a great example. I have a client who is an IT professional, right? 9 to 5, about 35, 40 hours a week doing that. And he owns about 40, maybe at this point, 45 or so rental properties, which are single family, small multifamily properties, and he self-manages everything. He does the renovations, he does, everything. He's told me he's spending about 60 to 70 hours a week, involved in his properties. And he has no problem whatsoever tracking that and claiming that status. It's going to be very difficult though. If you have one property, okay, it's going to be very difficult. So I hope that answers the question. Dan, email address. Omar, is consolidation better for multifamily? We can also consider it for any case in single family homes. Omar, it is going to be better for multifamily. It is going to be better for any larger property. And again, it has to do very much with the tax basis. Because if you remember, we're talking about the basis. We're talking about how much can be written off over time. And then we're talking about allocating a certain percentage of that, which depreciates faster. So on a $100,000 property, okay, if 20% is allocated to 5-year property, that's $20,000 that you could take over 5 years of extra depreciation, right? About $4,000 a year. It's not a lot. And again, that's deductions. That's not like cash in your pocket, okay? So to pay a few $1,000s or more for a consolidation study, it's not going to make any sense, okay? It can be done. And like I said, over $500,000, it usually does make sense and can make sense. Less than that, usually not. If you own, so Katrina asks, I see there's questions back in the question answer. I'm going to just answer this one in the chat box, but if you can all put it in the Q&A box, as Paul puts another in the chat box, we can just look at them together. So Katrina first, and then I'll go to the Q&A, come back to Paul. If you own 1/3 of the units in a condo project, and those units are used as short-term rentals, can you use consolidation on the units you own? Yes, you can, Katrina. Your depreciation is going to be based on whatever amount that you own, okay? It should be noted that that short-term rentals are usually, and this is a dispute, but it's usually treated as commercial property similar to a hotel. So it would be put on a 39-year schedule as opposed to a 27.5-year schedule. Just something to keep in mind. But yes, you can use a condo project. In fact, condo projects oftentimes will not have any land to it. So you're going to get all of the amounts invested is going to be the amount that's in the actual apartment or condo that you own and none allocated to land. So yes, you can depreciate that. You can take consolidation on that as well. Yes, so back to the question. Theodore asks another question. A property with $1 million that you're partnering with the seller, meaning their owner financing, say $300,000, so that you can gain a private money loan for the renovation, improvement, construction costs of $700,000. Does consolidation make sense on that sort of project? If so, when should it be done? Great question, Theodore. Very detailed, very specific. So if you buy a property, so the question is what it's worth, and it's also a question of what it was paid for, okay? What it's worth does not matter. If it's appraised for $10 million and you paid $1 million for it, your purchase price is going to determine and establish your basis, your tax basis, what you can write off, what you can depreciate. So even if it's owner financed, okay, on the closing statement, there is going to be an amount that is purchased. So if it was purchased for $1 million, your basis is going to be $1 million. Doesn't matter if you didn't put any money down on it. You can take, the IRS allows you to write off that $1 million the day you close that property, okay, from that time on. So putting $700,000 of construction costs is another aspect, and I mentioned this before. Not only can you do the consolidation study immediately on the purchase, on the acquisition, but you can do another study, and it's really supplemental. It's a fraction of the cost because it's just supplemental to what the original consolidation study was done, but it can allow you to get those deductions accelerated on the $700,000 of improvement costs. So yeah, when should it be done? Definitely worthwhile to reach out and look at the specifics. If you're demolishing a property, you cannot do consolidation study on that. You can only do it on a newly property when it's placed in service, okay? So unless it was rented out and your intentions were not to demolish it immediately upon acquisition, if your intentions were to demolish the property upon acquisition, you cannot take depreciation on it until it's been replaced in service. Okay, that we did answer live. I did, okay. Dawn, is there a certain price point on where consolidation would not make sense? Yes, I did answer that before, which was about $500,000 is where it's going to start to make sense. Over $1 million, basically a no-brainer. Under $500,000 usually doesn't make sense, but always worthwhile to get that extra, get that free analysis. Omar's question we answered before, which he asked in the chat box. Omar asked another great question. Omar is on the ball today. Omar, you must have had a strong coffee this morning. For multifamily deal of 1.3 million, 53 units closed in December 2019. When is the best moment to do the conservation study? Right now or later this year is still okay. So again, 2019 property, you're going to be filing 2019 taxes. Filing 2019 taxes means if it's a multiple member LLC, March 15th. Okay, if it's corporation, March 15th. If it's a single member LLC, even if it's you and your spouse, still considered single member, April 15th. So you need to get this done ASAP unless you want to put it on extension. Then you have until September, October. You have a little more time. Unless you don't want to get it done for 2019 taxes. You can wait and get it done for 2020. Again, it does not need to be done right away. It's something you can do later on. Can you perform, back to Paul. Paul in the chat box. Paul Lombardi asks, can you perform a cost segregation study after you've owned a property for a long time, 15 years, or is that too late or not make sense? As I mentioned before, you are allowed to. You definitely can. Does it make sense? It will all depend on the actual numbers. What are the specifics there? What we're going to do is we're going to look back. We're going to take those accelerated depreciation deductions that were not taken, accelerate them all into that 5-year or 15-year schedule, which is going to put it in year number 1. You're going to get a big fat lump sum in that first year doing it. And that can be very beneficial, for that first year. Afterwards, you're going to be left with, much less depreciation because you're front loading it all. Definitely can't hurt to look into it. So thank you for all your questions. I see we're moving right along. One more question from Ben. How are we doing on time, Dan?
Actually doing pretty well here. I was looking at it. You have about 3 more minutes left. So you want to take one more question here and answer that, and then we'll go ahead and wrap it up.
Sure. So Ben asked, do you have good rules of thumb for how much paper loss one could expect? For example, invest $100,000 in apartment syndication. I should expect X in paper loss. That is a very subjective question. It really does not. It was going to have to do not just with your $100,000 of investment. It's going to have to do with what is your percentage of ownership, okay, and how much is the property worth, okay, how much conservation, how much depreciation is being taken, whether they're doing bonus depreciation or not. There are a lot of factors in that. So unfortunately, I can't answer that question, but happy to discuss it with you further. Feel free to reach out discuss with me, reach out to me. Thank you very much. Thank you. This has been great. I hope everyone gained some knowledge or learned a little bit more about cost segregation today. And like I mentioned before, please connect with me on LinkedIn. That's where I put out a lot of content, help other people out, engage with people. So hook up with me there or Bigger Pockets, and let's keep this going. And
well,
thank you, Dan.
I really appreciate you coming on and presenting. I know for those of you who are curious, be sure to reach out to Yonah. I'm going to type in here his email one more time so you have it, and then also put in his phone number here so you can easily just copy and paste that from the chat box and send him a quick email. I'm sure if you ask him for the slides, he'll also give you those slides and he won't have any issues with that. And Yonah, again, thank you so much for being here. You're always a pleasure to have. All right. So it sounds like he might continue to have some connection issues, and I'll actually send him, for those of you who are watching and who watch this session, if for some reason you missed a few things because of the connection issues or something like that, we will make sure.
It's my pleasure. And
we will make sure that he maybe does like a redo of this webinar or gives us a little bit of a different video so we can show to you so you can have all of the content. But I would highly recommend you reach out to Yonah with Madison Specs for any of your cost segregation needs. And coming up in this room next, we're going into a 15-minute break here. Coming up next into this room is going to be the next session, which is using self-directed IRA and 401ks as a capital raising source. So make sure you don't forget about that session with Scott Maurer. with Advanta IRA. And then in room 2 during this session, right at 11 o'clock Eastern, we're going to have Build and Boost Trust Through Technology. Build and boost trust through technology with Todd Heitner. So make sure you choose which one of those you want to be a part of. And remember, we are recording each one of these sessions so that you will have access to them afterwards as one of our paid attendees. So if you went to the MFINsummit.com and registered for it, you will get the access to these recordings, and they will all be housed inside of the MFIN forum. So thank you guys so much. As we go into this break coming up, make sure you go to MFINpremium.com and check out the information. I went ahead and typed it into the chat box for you. Check out the information around the Multifamily Investor Nation Premium membership program. We also just sent you out an email giving you some more information about that as well. It's a 60-day free trial. Make sure you go there, sign up, and be a part of what we're doing here. I get probably 3 to 4 people a week asking me about doing some coaching for them, and I don't have the time to do a one-on-one coaching program, so I decided to do a different type of program to make it more cost-effective for everybody and allow us to be able to still give you some good, solid, additional premium content. So make sure you go there now. If you're not interested in that, you can certainly go to nextmfin.com and register for the next MFIN Summit, which is coming up in June 11th, 12th, and 13th, and looking forward to having you do that as well. So we're going into a break here. We will be back. And again, thank you so much for being attentive on this particular session here with Yonah Weiss.